Thank you for joining me for another episode of K the CPA. I'm Bill K, the CPA, and we're going to cover an interesting area in financial reporting, long-term liabilities. That's right, the stuff we expect to hang around on the balance sheet for a while, like that friend who keeps overstaying his or her welcome anytime they come over your house. Specifically, I'd like to explore financing types, so we could think about why exactly a business would prefer to go the long-term liability route, rather than other methods of funding growth and operations. After that, we'll go through a hypothetical example to tie our coverage all together into one neat little package. Businesses need to figure out two things. How are we going to fund all of our startup costs, and how are we going to fund our day-to-day operations? Startup costs can range from renting office space, to paying legal fees, to buying a building, to buying specialized equipment that you need to provide your products and services to customers. There's a lot involved there. Now, as for operations costs, you need to think about the cash you're going to need to spend on salaries, utilities, other fees, taxes, inventory, and more. This is where financing types come into play. A company will want to choose from a variety of methods to secure the cash needed to cover startup costs and at least a portion of those day-to-day operation costs, especially in scenarios where the company is just finding its footing and may not be making very many profits for the short term. Now, it's going to need less and less in the future as it gets profitable. The two major ways a business may finance its startup costs and its operations would be through investors and through the acquisition of debt. Sometimes finding investors is easier said than done, especially if not a lot of people believe in your new company. In many cases, debt will be a viable solution to cover costs that are higher priority and that may promote the growth and the expansion of the company. Another reason why a company may not want as much equity investment is because there would be too many owners of the company. You'll find many small to medium-sized companies prefer to have key management as the majority owners of their company. Now, if you keep issuing additional shares of stock, well, there's a greater risk that the key players may not be majority owners of the company anymore and can be at risk of losing control. Now, businesses will have a mix of equity investment and debt to fund their operations, their startup costs, and ultimately their growth. Now, the breakout between debt and equity is rarely balanced, but you'll find that there are a few distinct advantages of utilizing debt to accomplish short-term and long-term company goals. There are three common examples of what we would utilize as debt to fund the growth of a business. They include leases, notes, and bonds. Leases are an extremely popular method of debt where the business doesn't actually own the asset. In fact, the asset is owned by another party where they let the business actually use that asset for a while. Now, notes are also a formal agreement as well. This is another type of debt where the company will ultimately pay back the lender after a set period of time, not just the principal amount, but also interest. And finally, bonds. Those are issued for people like you and me to purchase, where interest is paid 1 or 2 times a year, usually twice a year, and ultimately the full amount is paid back at the end of the bond's life. Now, there's a lot more complex variations of bonds out there, but for simplicity's sake, we'll just say that full amount is paid back at the end of the bond's life. Now, each of these are excellent ways that a business can leverage debt to meet its goals, but there's one extra advantage, which is tax savings. In many cases, debt financing involves a component of what's called interest expense. Interest expense is deductible for tax purposes because you're lowering your taxable income reported on your company's tax return, which that sounds great. So in a lot of cases, managers of companies prefer to reduce their tax burden. If it means they can fund company growth for the long term while paying fewer taxes in the near term, well, that just sounds like a win-win. So let's go through an example. This is one about what we like to call Bill's Shirt Company, because hey, I'm in the business of getting into making some excellent top quality T-shirts. But here's my problem: is I'm a relatively new business. I'm running light, as far as who's employed within my organization. It's really just me right now. So I'm not necessarily looking into going out and getting a bunch of investors to own my company, because I want to run things my way, and I don't want a whole bunch of people who are putting a few $1,000s here and a few $1,000s there to tell me how to run my business. So I've invested my own funds, but it's not necessarily enough for what I'm trying to do. So at this point, I'm looking to buy a t-shirt printing machine. Up to this point, I've been doodling on t-shirts by hand. It takes a lot of time. It's not the most efficient methodology. I can't quite sell enough t-shirts to make that much of a profit because it takes me so long to make t-shirts. Instead, I want to get a t-shirt printing machine where I could upload my designs, print it out. But let me tell you, these t-shirt printing machines cost quite a bit of money. So I'm not necessarily currently having enough in my bank account personally, based on the lack of profits I've been bringing in, to afford this machine. Now, knowing if I do end up buying this machine or getting my hands on one of these machines, well, it's going to triple my company output at a very minimum. I would say 5 or 10 times more efficient, but we're going to keep things conservative and say that this t-shirt machine will triple my company's output. So would it make sense to go and get a loan, even if it's a few year loan, maybe a 2, 3, 5 year loan, to cover the costs of this very expensive piece of machinery, when it could actually turn my company from being in a loss position into a profit position? I would definitely think about that. Well, at the same time, even with the fact that my company may be turning a profit after installing this machine and furthering my t-shirt production, you got to keep in mind another factor that we talked about before, which is that reduction in our net income, our taxable income, because now there's going to be some level of interest expense that I'd have to pay on, an annual basis there to pay that interest expense. And when you're paying interest expense, you're reducing your net income, meaning that, well, now there's a lot less for the government to assess taxes on, because my net income has actually been reduced. So there's a few benefits there, especially if you're in a position as a company like in Bill's shirt company here, where the opportunity for profit is there after making this type of investment. And if I'm in a position where maybe my capital structure is pretty solid there on the equity side, where I don't want to make any further equity moves, I don't want to issue any further shares of stock, debt is the best option to go in this scenario for those multiple reasons we just discussed. So you can see how even a very small business like Bill's Shirt Company, you can see those added benefits of having some component of debt within your business. So you could definitely take a look at real world examples of actual businesses, not just Bill's Shirt Company, and you'll see that so many businesses will utilize debt in a very strategic manner. So pay attention to what's going on out there and understand that there is a level of healthy debt, and there are some advantages to doing that, because otherwise, in my scenario with Bill's Shirt Company, it could have taken me years and years and years of trying to do all these t-shirts by hand and waited until I can scrounge up enough cash to ultimately then purchase this machine, when I could just go out within the next week or two, get a loan from the bank, and get that piece of machinery ASAP and start growing my business much sooner than if I was relying on my slow profitability. So there's a lot of strategic advantages to utilizing long-term debt, and hopefully this gives you a little bit of insight as to at least to some of the impacts that you could see here. So anyway, thanks for joining me, and this was another fun episode of Bill K the CPA.